been complete chaos. No other word for it. Really tired. Trying to keep up.
There is a ton going on in the markets, especially in terms of commodities and inflation. We have markets potentially teetering on what are historically high levels and potentially looking at being shorted by pretty much everyone and their mom. We are diving deep into Bitcoin macro.
The legacy financial system is just behind on this. It breaks their brains. They don't quite understand the time value of money. Bitcoin doesn't offer cash flow. I think of it as a tool to save for my future. It's going to be volatile in the short term. I'm completely okay with that. Eventually, they'll all go to $100 million per Bitcoin.
C3, okay, a millionaire. I'm a young money millionaire.
Good morning, good afternoon, and good evening, everyone. Welcome to the Thursday edition of the Daily Stack Macro. We're joined by, once again, our macro expert, Robert Infronomics. And this week, we were lucky to have Rajat Soni on as well, guys. We are diving deep into Bitcoin macro. We have the Strait of Hormuz, which is being closed and utilized as a geopolitical weapon. We have markets potentially teetering on what are historically high levels and potentially looking at being shorted by pretty much everyone and their mom. In the current state of affairs, we have Bitcoin chilling at 70K, and it just seems to not give a flying you-know-what. It's been hovering around here for the last couple of weeks. Everyone thinks we bottomed. We're diving deep into Bitcoin once again, macro. We have everything in terms of today's topics. Let's take a look. We have financial advisors, why they hate Bitcoin, which hopefully Rajat is going to opine on. We're diving into STRC. We're diving into whether or not 0.1 BTC could be life-changing. And then we're going to dive into some macro at the back half of the show for the last 30 minutes. So let's get into it. Rajat, how are you doing this morning? And how's Bitcoin treating you?
I'm doing great. Thank you so much for having me. It does what it does. I think of it as a tool to save for my future. It's going to be volatile in the short term. I'm completely okay with that. It's treating me well.
That's amazing. Infra, Rob, how are we doing on your end? How's the week been treating you? What's going on in macro?
I don't think I've been this busy since April 2025 and Liberation Day. It has been complete chaos. Yeah, there's just no other word for it. Chaos. Really tired. Trying to keep up.
Yeah. Well, there is a ton going on in the markets, especially in terms of commodities and inflation, which we'll get to in just a moment. But let's begin with Rajat. Rajat, there was one thing that I wanted to kick the show off with, and that's Bitcoin as a tool. You mentioned it as a tool for savings, specifically within the quote-unquote TradFi community. So I read an article, which I'll pull up in just a moment, about how TradFi struggles, specifically financial advisors struggle to understand Bitcoin. So I wanted to get your take on this because it's something that you clearly are familiar with, and you've got a quote-unquote TradFi background. But yeah, so what is your take on that as a topic?
I don't know if most of TradFi quite understands Bitcoin yet. I think that what they're doing is they're valuing Bitcoin based on the legacy financial system. So the old paradigm where we bought assets to earn cash flow. So we bought let's say real estate, we bought stocks, we just bought all these different assets to earn cash flow to pay for our expenses, and Bitcoin doesn't offer cash flow. So that just breaks the entire system. It breaks their brains. And it took me a while to get to that point because I was surrounded by cash flow yield for a very long time. I worked at a brokerage. I worked in asset management in a bond. Within a bond fund, we were just rebalancing portfolios. And everybody was just thinking about cash flow, cash flow, cash flow. They didn't really care about whether the cash flow is actually retaining its purchasing power. They didn't look at it from that perspective. They thought 2% cash flow is better than 1%. 1% cash flow is better than 0.1%. They didn't see it as the cash is dying, so the cash flow you're getting is actually decreasing in purchasing power over time. So to the people who look at the world from this perspective of cash flow and income producing assets, they can't understand how Bitcoin is going to replace those assets. They can't understand how if you buy Bitcoin, for example, as a savings vehicle, it's going to extract value out of, let's say, housing, because housing right now is being used as a savings vehicle. So the more money that gets funneled into Bitcoin is money that won't go into the housing market and prop up prices of houses because it's being used as a store of value. So a lot of people today, in my culture, for example, I'm Indian, a lot of people buy houses as a savings account. They don't buy it because, they buy it because they want to live in it, but they think of it as a forced savings account. That's just how they look at it. They want to buy bigger houses. They want bigger land because they want to save. And now Bitcoin is a better way to save. So when you see it from that perspective, I think a lot of wealth is going to move from the real estate market into housing over time, but people into Bitcoin over time, but people don't really see it from that perspective. I think the legacy financial system is just behind on this.
So I guess you deal with a lot of great content that you've been putting out. So specifically focused on making Bitcoin easier to understand, right? So first off, props to that, because it's what we need more of, right? We need to educate people on why money decays over time, because inflation is this hidden tax. So first off, that's fantastic, and congrats on the content that you're putting out. It's super easy to understand, and I think a lot of people really appreciate it. My question for you is, what is maybe like the biggest insight that you've had from teaching people, and the biggest dogma that they've encountered, and how do you get past that dogma? Because people aren't necessarily looking out every day for, how do I save my wealth and how do I protect my wealth? That's not the top priority. Typically, the top priority is generating wealth, creating wealth, not necessarily saving it, right?
Yeah. Most people, I think most people are focused on earning value. Like, they're just focused on making more. I don't really think they look at how the value that they save has to be kept. They have to hold on to that value somehow. They don't understand that $100 today isn't the same as $100 10 years from now. They don't quite understand the value of time value of money. Yeah. That concept, that compounding over time.
Yep, and I think that idea of a lack of, first of all, it's not tangible, but also, as you mentioned before, the lack of a specific cash flow model that they can predict out into the future and say, hey, let's DCF those cash flows back to today's value in order to arrive at a quote unquote TradFi approach for valuing this asset, like what's its inherent value. And the lack of that is something that's missing substantially, which inhibits their ability to get through this mindset of what exactly Bitcoin is and how to appropriately value it. Plus, you have the volatility then built on top of it, right?
Yeah, and that scares a lot of people because it's unpredictable. They don't know. They can't. I think a lot of people can't really see how something digital can have value, because the old paradigm was anything digital can be multiplied, right? So you have pictures, for example, they can be multiplied. If I send you guys a picture of something, I'm not the only person who has it now. Now there are 3 copies of it. So that's how they think. I think that's how they think of it. They think that somehow this finite supply can be broken because it's digital. They can't see how the supply can remain the same. And I think over time, Bitcoin is just getting through these tests where, for example, the halving, if it was the regular fiat currency financial system, I don't know if the halving would stick, because there would be so many companies going bankrupt, and there are companies that are considered too big to fail, and we'd find a way to bail them out. Whereas with Bitcoin, it doesn't give a shit. It doesn't care.
Yeah.
All the companies who are no longer profitable, they're going to go bankrupt. So with Bitcoin, I think that was a test. And every time it goes through a halving, it just adds another layer of conviction and confidence. And over time, let's say, for example, the people who don't see it this epoch, they're going to see it next epoch. If they don't see it next epoch, they're going to see it the following epoch. And eventually they'll see it. And I guess this is where the phrase, you buy Bitcoin at the price you deserve, comes from. If you don't see it early, you're going to see it later, and you're going to pay a lot more for it.
Yeah, and it's not just Bitcoin either. I spoke with the CIO of a very prestigious firm and asked him we were talking about the S&P 500 equities and kind of broad terms and, our outlook, and he was bullish. And I said, okay, cool. Yeah, I'm generally bullish too. This was, I don't know, a year ago. But I said, is it going to outperform gold? Right. And he was like, I don't know. And I don't care. It's like, well, that seems odd to me because now I granted gold and Bitcoin will have volatility, right? But over long periods of time, those are the measuring sticks to use, right? Not the dollar, which we know is melting. I mean, if you look at the M2 growth rate, it's 6, 7, 8%, depending on the time period you look at. Debt, right, grows at 8, 9, 10%, depending on the time period. So, yeah, the S&P 500 might return, 8% on average. But if you're not outperforming the actual money supply, then what good is to me, it's kind of shocking how, and again, this was CIO of a very, very, very prestigious firm, and didn't even think that it was worth talking about. So, it gets to a deeper issue than just Bitcoin. It gets to, I mean, because we were talking about gold, I think it just gets to a deeper complacency almost with the way that our system is structured. There is this immense kind of this is my perspective, immense complacency that traditional finance has when it comes to America, when it comes to being a developed market, when it comes to some of these things, and to me, it's just, it's a bit scary almost to remember that a lot of people trust the experts with their money, with their wealth, right, with their family's wealth. And I think that given where things might be going over the next decade, it could pose some real issues for them. And I think that is finally kind of when they will actually wake up. I think unfortunately, a lot of times, humans need that pain point to really understand. And I think that you would kind of think that 2020, the past, I don't know, 5 years, that period of time, you would kind of think that would have been a pain point enough, but clearly not. So I think a lot more people will be coming around to, a lot of these concepts, unfortunately, with pain.
Yeah. And sorry, Rajat, you actually had a bit of a run-in with the CFA, when was it, last year, where they were kind of refusing to acknowledge certain methods of understanding Bitcoin. Or do you want to run us through that and kind of what the takeaway was from that whole debacle?
Yeah. So I think maybe sometimes I get a little too bullish on Bitcoin because I genuinely think this thing is going to go up forever because the US dollar can lose value forever. There's no supply limit for the US dollar. It's just like compared to Bitcoin, every fiat currency is exactly the same. Eventually, they'll all go to $100 million per Bitcoin because the supply will keep rising. The financial system needs the supply to keep rising. So the way that I was looking at it is Bitcoin's eventually going to go to 100K. Then it'll, this was back in 2024, 2023. It'll go to 100K, then it'll go to a million, then 10 million, then 100 million. And somebody reported that I was basically making claims that aren't realistic. And if you don't understand Bitcoin, I can see where that's coming from. It doesn't make any sense. But if you do understand Bitcoin, you can also see where it's going because the US government is going to accelerate its debt, the growth of its debt. It's going to keep borrowing money because it can. Why would it stop? It has no reason to stop. Even if things go well, they'll continue to borrow. It doesn't matter. If things go well, interest rates will be down. They'll continue to borrow. They'll borrow more. They don't care. So the supply of dollars is going to continue to rise. It will continue to rise forever. So my idea was essentially that Bitcoin is going to go up forever. And I mean, that's the base thesis of Bitcoin. So they asked me, what is your basis of this? And they were basically asking me for a 5,000 hour lesson on where Bitcoin is going, how to answer every single nuance, how to answer every single like myth and all that. And I just responded to them, can you tell me your basis for the S&P 500? And they escalated it. They escalated the issue. They didn't really have a response to that. They escalated the issue and they said that the investigation is closed. It was basically the fact that they didn't understand what Bitcoin is. They hadn't done the research. they probably hadn't read any books. They hadn't watched the show, right? I mean, they had no idea what it was.
Well, and they also don't understand their own the structure of their own system, right? Like if you were to ask them, what's the growth rate of the money supply, I bet you they wouldn't have an answer, right?
Yeah.
So that, like at a fundamental level, it's kind of terrifying that some of these organizations, whether it be CFA, FINRA, the wealth managers, they don't even really necessarily understand how our own monetary system works, how what the debt growth rate is, what interest, how that is the dynamic of the interest expense and the deficit. Like a lot of these things, they don't even really, they kind of know it as like almost an abstract kind of thing, but they don't really understand. And I think that's kind of the fundamental problem, because once you understand the way the structure of the system, once you understand that, then Bitcoin is kind of almost like obvious. It emerges as kind of a logical answer, right, to our current system.
Yeah, and I'll give you my own example. I used to just assume that inflation is 2%. When people would tell me it's 2%, I would question them. I'd say, no, you don't know what you're talking about. I have my CFA. It was ego, right? It was all ego, and I didn't understand the system, like exactly what you explained there, Rob. All of that, I didn't understand it before I studied Bitcoin, even though I'm supposed to be the expert. That doesn't really make any sense to me. And now, just going through that makes me question everything. When people say, house prices will go up forever, of course they will in terms of US dollars, but in terms of Bitcoin, they won't. And I genuinely think, I don't know, maybe you can give me your thoughts on this, but I genuinely think that banks are not going to lend to buy houses over time, because it's much more difficult to collect your money if your borrower defaults. I think they'd rather be in the business of lending against Bitcoin.
Yeah, I mean, that's really the key for young people and using Bitcoin as a prime wealth generator, right? Our parents had the home, and there's significant leverage associated with buying a home, right? You can get 10, 20x leverage. And I've always kind of framed it in the way that housing is not building wealth. Like you mentioned, housing underperforms gold. For example, the number of ounces needed to buy a home, the number of ounces of gold to buy a home today is like 70, 80% lower than it was just 20 years ago, right? And in fact, the average home price priced in gold is at like basically a record low going all the way back to the 1960s. So as a real wealth generator, to actually outpace inflation, it's pretty terrible. Now, the benefit, and the way I frame it is housing is just levered exposure to a relatively scarce asset, being the home. But the supply of homes can always go up. All it takes is maybe a Zoomer getting in power and enacting a national strategy. We're going to build 5 million homes, right? And the supply of homes can go up. So really, the wealth that our parents generated, it wasn't real wealth. They weren't outpacing gold or inflation or M2 money supply or any of those things. They just got levered exposure to a relatively scarce asset. But we know Bitcoin is immutably scarce, right? So the potential for real wealth creation, if banks were to do a 30-year mortgage for Bitcoin, I've always mentioned that that's really the sticking point. For a young person, if you can save, I don't know, $5,000 a year, right? You're paycheck to paycheck, but you can scrape together maybe $5,000 a year. Well, if you put that into Bitcoin has, if Bitcoin doubles, you only made 5K. But if you are able to use that as a down payment for a house with 20x leverage, that $5,000, right? Homes don't have to go up nearly as much. They don't have to double for you to make the same amount of money. So I think that leverage component is really the key. And the difficulty that I kind of foresee with that is just the volatility. Loaning against volatile assets, is going to be carry higher interest rates for one. And I think that they'll be, more reluctant until the volatility comes down. But we're already kind of seeing that with the structured products that are being launched with the Bitcoin ETFs, right? We're already kind of seeing that vol get compressed. And so I think, it's a definite potential, but I think that volatility is really kind of going to be the sticking point for them. Now, between us, we would all love to take out a mortgage kind of thing, on Bitcoin. But I think the banks are hesitant now, given the leverage, the volatility associated with Bitcoin.
Maybe I have a bit of a different view on that. So I think that the volatility doesn't matter to banks. I think it's more about competition, right? So let's say, for example, if more lenders come out with, let's say, for example, JP Morgan starts lending at a 6% interest rate, and then Bank of America comes out with a product, or not 6, but let's even go with right now. What's the rate right now? Maybe 11, 12%?
For Bitcoin backed loan?
Yeah. From
11, 12.
So then 11 through till about 14, 15, including.
Oh yeah, there you go. So let's say, for example, one of these big banks come in and they're like, we'll offer you 10%. And then another bank gives you like an intro offer of 9%, then 8.5%, then 8%. I think it could keep going down. I think that's more of a lever rather than the volatility. Maybe I'm wrong on that.
I definitely agree with that. I just, I think that eventually we're going to see that kind of competition, right? And you'll get a compression of the spread right now, which, with Fed funds at 3.25, call it 3.5, 11% interest rate for a Bitcoin backed loan just seems kind of incredible, because it's fully collateralized, right? Especially if you do a low LTV. But it just, my sense is that the banks or the providers that are offering those Bitcoin backed loans, what are their capital requirements and constraints, and what is the structure of the terms that they're getting? Are major banks loaning to them? I think, though, that 2, 3, 4 years down the road, if we continue with a kind of pro crypto, pro Bitcoin kind of approach, I think you could definitely see like a huge explosion as the major banks start to provide capital to the Bitcoin backed loan providers. And then you can probably get that compression of the it's pretty incredible spread, to be honest.
Yeah, huge spread.
Yeah, the other thing I'll say is that, we can all say and sit here and hypothecate on JP Morgan coming in from a competitive standpoint, but there's also the manner in which those banks analyze risk. So value at risk, I think, is the metric that they look at, which accounts for volatility. So they can only have a certain amount of volatility in their quote unquote exposure. So that's probably one of the biggest limiting factors right now in terms of, or at least something that I believe that's inhibiting them from potentially giving out, let's say, Bitcoin backed loans. Plus, I don't know the market is big enough for them to actually warrant taking on all the risks and headaches of a decentralized, currency, right? And yes, it's something that down the line, surely it has to come once volatility is compressed and once Bitcoin's at 500 to, $1 million. But right now, I can understand why they would be reticent to potentially go into that market.
I don't think volatility is going to be compressed. I think volatility is going to get crazier over time.
To the upside volatility?
Yeah. I think upside volatility is going to get insane. I don't think it's going to, but with upside volatility comes downside volatility, right? Like there will be a drop from, let's say, $10 million to $4.5 million. That'll probably destroy a lot of people. There will always be over leverage, but I think over time, the volatility is going to widen. I think there's going to be bigger spreads, but then even with that, the best thing is with these Bitcoin backed loans, they can just sell the collateral whenever they need to. So there's less risk. I would say Bitcoin backed loans have less risk than mortgage backed loans.
Well, so like when I was mentioning vol kind of getting compressed,
Yeah.
it's the kind of thing like you have all these providers and funds running short vol strategy to generate income, right? And we saw that after '08. We
Yeah.
saw the kind of explosion of these income generating short vol strategies. And look, like it works for a while, but when it blows up, it really gets crazy because these funds, if they're selling calls against Bitcoin, and Bitcoin stays range bound or goes down, yeah, they're going to generate income and no big deal. But like if Bitcoin shows what we know it can do, upside volatility, man,
They get wrecked.
yeah, if you're
Okay.
selling, millions of thousands, hundreds of thousands of calls, I mean, there's a number of these products already, and interest because Bitcoin's been going down. But look, all it takes is, sharp upward move and all those call sellers get just absolutely wrecked. And we saw that after '08 with Volmageddon, So
Yeah.
I do agree that there's potential for that. Yeah.
Well, let's get into that. So on not only in the volatility side, but let's get into kind of stretch and the MSTR product. I know you guys both have potentially opposing views on this. But Rajat, why don't you maybe run us through like just the audience itself at a very high macro 30,000 foot level, what stretch is, and why it's such a unique product specifically for strategy, and why you're bullish on it, especially given the current environment where sentiment is pretty poor at the moment, and all these Bitcoin treasury codes are kind of struggling, except for the big dogs like MicroStrategy at that level.
Yeah. So from my perspective, this is actually something that I saw in a video from my friend Forrest Hoddle. Go on YouTube, find him as well. He has really great takes on this. But the way that he said it was that Stretch is a savings account that gives you. It gets rid of the volatility. I'm kind of expanding on what he said, but it gets rid of volatility, gives you an 11.5% return. And while Bitcoin is going down, more people will probably want Stretch because they want to get out of the downside volatility. They don't want to be holding that falling knife. So what they're going to do is they're going to sell their Bitcoin, buy STRC because they want that consistent return of 11.5%. Strategy actually has a 2.5-year reserve of fiat to pay for the dividends on STRC and all of its other preferred products. They can generate more cash seemingly whenever they need to. I don't know how long that'll last for. I personally think that they'll be able to do it forever just because the world wants exposure to Bitcoin. They are the biggest holder of Bitcoin. They have the biggest moat. It's like, let's say, for example, Apple, they have this massive competitive advantage, but their competitive advantage can be taken over by somebody else. They could come out with a better product. They could come out with a better funnel to sell to their customers, but nobody has done that yet. With Bitcoin, with what Strategy is doing, nobody can replace them as the top holder of Bitcoin at this point. Nobody. It's not possible because they keep buying. And now they've actually created a new product. Forrest actually calls it the iPhone moment for MicroStrategy, where they created this product that gives you a fixed return of 11.5%, or not fixed, variable, so it can increase or decrease based on demand, supply and demand. But let's say 11.5% today. Let's say long term it stays above 10%. So you have this savings account that allows you to save for the short term, medium term, up to 2 years. You're guaranteed your dividends. Strategy can seemingly generate more cash whenever it needs to by selling shares of MSTR to pay for the dividends, and it stays at $100. That's it. It gives you basically the same return as the S&P 500, but it's not volatile. So if you put your money into it, let's say, for example, you put $100 a week into it, you keep doing that for 30 years, your portfolio is going to go up to $1.3 million after 30 years. And that's what people want. That's what the average person wants. The average person doesn't care about self-sovereign money. They don't care about censorship resistance. They don't care about, oh, the bank might close my account. They don't even know that's a possibility. They haven't thought of it in that in depth. So to them, I think that this is the product that's going to change their perspective of MicroStrategy. MicroStrategy is it's created this product that's backed by Bitcoin. Now it's giving everybody that dream of what they want. They get that consistent return. They get that cash flow. So it's basically catering to the fiat currency financial system's needs. So anybody who participates in it, they're having their needs catered to with STRC. And because of that, I think that this could be probably the biggest product in financial history. STRC can take over pretty much any market. It can take over the bond market. It can take over part of the real estate market. It can take over part of the stock market. Like SCHD, for example, Schwab's fund, they give like a 3.8% yield, and they're worth $150 billion, whereas STRC gives a 11.5% yield. It's backed for 2.5 years with cash, and it's only worth $3.8 billion so far. Money market funds give a 3-4% yield, and they're worth $8 trillion. So all of that money can go into STRC, which can go into Bitcoin. So to me, that's the game changer.
So I'm going to take a counter to that and ask, if Bitcoin has historically performed and to 21% as a CAGR over the last 11, 12, whatever years it is, why would I want to then give up all of that upside in exchange for a fixed 11.25% yield? If I understand,
you're short vol. It comes down to, do you want to be short volatility or long volatility? Because Bitcoin's benefit, the way you are benefiting is by being long volatility. But, there's short volatility is, if you're older, close to retirement, that kind of thing. You need stable income. You want that short volatility sort of approach. I could see why it would be appealing. My question would be like, but why isn't there more demand? If it's if it's so great, why isn't there more demand? And also, I would just point out, like, from the sound of the guarantee of the dividends, like, we'll just dilute the equity holders. Like, I definitely probably don't want to own MSTR. If I'm just going to get dumped on to fulfill the obligations to STRC holders.
I don't quite agree. I don't quite think of it that way. So let's say, for example, if I did the math on this. So let's say, for example, let me ask you a question. So where do you think Bitcoin will be in 2029?
2029.
2029. Do you think it'll come back to its previous all-time high?
Oh, well above by then, yeah.
Okay, so if it goes back to its previous all-time high, then let's say it goes to the previous all-time high. That's like a 20% return from here, right? If they pay 11% in terms of dividends, 11.5%, they would have paid like $36 million in dividends in that 3-year period. Whereas the Bitcoin would have grown at 80% in that 3-year period. So what they did is they basically used the real estate playbook by using other people's money to buy an asset that grows much, much faster. And they didn't have to do anything to get that money. All they did was they paid a fixed dividend. They absorbed the volatility. So me as an MSTR holder, I'm okay with being diluted, because technically, let's say 1% of my shares are diluted each month, but I'm getting a 3% return on Bitcoin because of the strategy that they're putting. Yeah, exactly. They're putting forth this strategy, which I probably can't do on my own, and I'm buying the shares and I'm letting them take advantage of it.
Yeah, I agree with all of that. My concern, or my fear, my apprehension would be, what if Bitcoin goes down 50%, 60%? That would really be where I would kind of, because I agree, if Bitcoin kind of just doesn't show immense downward volatility and just kind of continues to move higher, I totally get it. My apprehension would be, what if it falls 50%?
And that's 60%. A flash crash? You mean like a flash crash, or do you mean a sustained?
I mean, downward? Like a recession, right?
But it did fall 50%.
From here, though.
It was down 50% from the top, right? I mean, and it stayed at 100. It like the volume is actually going up on STRC.
Yeah, I just worry about the whole kind of complex being subjected to a 2-3 year recession. That's not my base case. I think that they print pretty quick, but I do think that, like, there's almost not you, but just in general, there's this kind of like baked in assumption that Bitcoin will just kind of always go up. It'll have its, crypto winter, but generally, there is a potential, despite the M2 money growth, supply growth, and despite fundamentals, there is a potential. Now, it's not my base case, but like, if that kind of environment were to happen where Bitcoin fell another 50% and maybe it didn't move higher for a couple years, then like how does everything kind of hold up?
I mean, if the way that this product is performing, it seems like it's going to be able to handle that. Right? They've gotten record volume. Like if you take a look at the volume, every single day it's going up. They have so much demand for this, and what they're doing is they're just turning around and buying Bitcoin. So they're giving Bitcoin a floor. Right? Like just today, there are actually websites that, like there's one STRC.live. Not sure if you guys want to pull that one up, but today they've bought 2,600 Bitcoin, which is absolutely nuts. And then on top of that, they're selling shares to buy more. So they keep accumulating more of it, right? And that I think that gives it a floor.
6 times 100.
Like they bought 2,600 Bitcoin just today.
Yeah, for yesterday, the volume has been ramping up, going back.
It's going nuts. Like this, and this is like I said before. I think this is what satisfies people's need for financial freedom, because all they have to do is buy this thing. They don't have to do anything else. Strategies like let's say, for example, with the iPhone, people wanting to be able to communicate with their friends and family. Apple gave them this thing that they can do that with without having to think about anything else.
So why is it? Why I've looked at it before. Why does it go down to below par? Go down to 92, and why does STRC have those?
So from what I understand, I think the volume wasn't high enough before, and as a result of, let's say, Bitcoin falling 56 or like let's say 10%, 15%, I think people just it's emotions, it's fear. Right. So if people think that, oh, Bitcoin's falling 20%, maybe it'll fall another 50%. And then it gets that floor and people start, I think temporarily the volume to the sell side is so high and it's more than the demand of the market, and it falls. And then it does come right back up. But it seems like over time it's just stabilizing, right? Like if you look at the price over the last, actually all of March, I think it's been above $100.
Yep.
And then there's also so one thing that I've noticed, I don't know if this will continue, but the ex-dividend date usually it falls slightly just to account for that dividend. So what people do is they buy it the day before, like today, for example, they buy it and then they sell it tomorrow to capture that dividend, and then the price falls. But then I think that the way that markets work now, everybody's looking for every arbitrage opportunity. So if they see that, oh, the price is going to go down 40 cents this day, so I'm going to buy it. It's going to go back up to 100, then I'll sell it back at 100. And I think more and more players want to do that, and they want to capture every penny. Every algorithmic trader is going to do that. They're going to leverage that up. I think because of that, it's going to become more stable at 100. But I don't know, that it could take some time. It could take maybe a few more months. Keep in mind, it's only been around for 8 months now.
Yeah, we should overlay the Bitcoin price on top of this chart to see if if that would actually correspond with those big drops. But it looks like it in that November-December period, and then I guess in Feb we also had a bit of a wobble on the Bitcoin price, so it does correspond shortly.
I actually did look at that, and I have the chart on. I had the chart on TradingView. Let me see if I can actually pull it up. I can show you guys. Let's see here. Here it is. Okay. Not the greatest with TradingView, but I'll share my screen.
Yeah, they do line up. I just pulled it.
Yeah, and then it lines up. If you also look at the dividends, whenever it pays the dividends, it lines up there too. It slightly falls on the ex-dividend date, and then it comes right back up. I'll get rid of the. I'm not the greatest with this thing, so let me get rid of this, and then I'll go back to STRC. So STRC falls whenever you have the X dividend date. So let's say, for example, this month's X dividend date would be tomorrow. So if you hold it tonight, if you're a holder of record, I guess tomorrow, then if you sell it, you still get the dividend. So tomorrow it'll probably fall, and I guess we'll see if that happens. I don't know how much it'll fall, but it could potentially fall maybe $1.
So you could then go and capture that spread and arbitrage it based on how many contracts or futures contracts you buy or sell based on that dollar arbitrage.
Right. So let's say, for example, if there are more buyers, that spread is going to keep falling. And I think that's exactly what's happening with this thing. So if we go we can see the volatility is actually, it's staying closer and closer to 100. And then
it's like an uptrend.
Right. As it gets to 100, it stays there for longer and longer. Right. So you can see it dropped to 93 here, it dropped to 90 here. Here, this is where they issued it. They started issuing it at $88, I believe. And then it went all the way up to 98. Then it came back down, went back. It's like the same kind of cycle, but over time, I think this is just adoption. So yesterday, it was actually at $100.16 during a video that I was filming. So I was filming it while it was at $100.16, and they had to actually sell into the market to bring the price back down. So you can see here, $100.18.
So why would this trade above par then? I mean, below par makes sense.
People, it's like a bond, right? People want it. They want the cash flow. So they want to keep buying it. But I think what's going to happen is maybe over time, they're going to have market makers that sell at exactly 100. And then ones who buy at $99.99, they buy at $99.99 and they sell at $100.01. They can add more volume to that. They could make it the most stable ETF in the world, or a stable preferred stock in the world, if they really want to.
So do you think that there's potentially even more demand coming in from the other BTC codes? Because if you look at, the Strive recently purchased another $50 million of STRC, and I'm not sure if
I didn't even know about this.
if additional treasury companies are going to start doing this as well. But I mean, this also starts to remind me a little bit of the 2008, financial crisis, where we had CDOs and then CDOs squared, where people would just, basically everyone was involved in the same trade. So this does give me a little bit pause for concern, just in terms of the concept or the principle behind it. In terms of Strive, wouldn't they just be focused on their own product? Why do they necessarily need to then go in and buy strategy? And could this potentially be like a downside risk if things do turn negative and Bitcoin does have another 20, 30, 40% wick down, like, Infro was talking about?
I didn't even know about this. I didn't know that Strive, I don't think I saw this article. I didn't know that they bought it, but I think that anything in number 2, number 3, number 4, they've lost the race already. So they're kind of contributing to strategy's growth with STRC.
Yeah, because I mean, I'm getting really bearish right now. Not this conversation, but with oil doing what it's doing, and the history of what happens after these energy shocks, it's looking pretty dicey in my opinion. It's looking pretty dicey.
Infra, because you got some really great charts as well. Let's dive into oil. What the heck's going on there? CPI, we haven't even got to that. And then private credit as well. We have to get to that. Like, that could be a huge potential risk, which is probably contributing to, I'd assume, as to why you're so bearish, right?
Private credit, AI, and oil. Yeah. So here, XLE, which is energy, just broke out of this downtrend that's been in place since 2008. This is looking at the relative performance of energy, the energy sector, very, very small component of the overall index relative to the SPY. And we are seeing it start to break out. So the Strait of Hormuz is effectively closed. Here we can see the traffic is down by about 90%. This is the largest oil market disruption ever in history. Here is the production hit per country. Some of these are just incredible. And further attacks continue from Iran onto oil infrastructure in the Gulf. Daily SPR pace. So, of course, policymakers announced that they would try to release some of the SPR to suppress oil prices. The problem is the flow rate, which is what that is showing. And then here is the scenario, depending on how long this ends up playing out, according to Bloomberg. So if the Strait of Hormuz remains closed for 3 months, oil will go to 160. If it remains closed for 2 months, it'll go to 140. I think that's more than enough to cause a recession. Here we can see oil over the past couple days has been incredible volatility over the past couple days. I tried to overlay some of the key events here. When it comes to oil, I would point out that like both the U.S. release of the Strategic Petroleum Reserve and also the International Energy Association announcing they would release the largest oil supply on record, 400 million barrels. Oil's gone up. It hasn't gone down, is gone up. Now the curve is, very backwardated, of course, but I think that, it was just a year ago with the last conflict over there, people were reliably telling me, oh yeah, Iran cannot close the Strait of Hormuz. There's zero possibility for that. It's not possible.
And these are geopolitical experts, right? That had all these
the experts. And they didn't have to, they don't have to with their Navy go out there and like block it physically, right? Put up a wall. They just have to make it, too expensive, cost prohibitive. Now we've seen the U.S. Department of Insurance and Finance or whatever it is try to backstop the insurance. But yesterday we had 4 tankers hit in the Strait, in the Gulf. We had 4 tankers blown up by Iran. So the risk, whether or not it can be priced, is kind of question number 1. And question number 2, obviously, like, is it even possible to suppress the Iranian offensive weapons, which, the Navy was saying just a day or two ago that it would take weeks to reopen the Strait. So I think that what I'm trying to get at, over the past year, 2 years, everyone has been way too bullish on U.S. military strength and way too bearish on Iranian capabilities. Is that to say Iran is winning? I don't know. They're causing a ton of economic pain, however, and if this continues, which again, I think we should err on the side of, whoa, everyone thought that this was not possible, and it's now day 9 of it, right? Like that should be a wake-up call where we might maybe reassess our super bullish, sort of expectations of the U.S. military. That's all I want to say with that. And we know that with oil, when the price of oil spikes, that is a late cycle sort of indication, and generally the US will go into a recession after that oil spike. Going into 08, oil went from 55 to 135. In .com, oil went from 12 to 33. This is log scale. And you can see that every time before a recession, oil is moving higher. Now, 2022, we had an energy spike and no official recession. However, we did have 2 consecutive quarters of negative GDP, traditional definition of a recession. And we also had an equity bear market. So oil is moving higher on an already stretched consumer. We know if you remove the AI CapEx story, GDP would be about flat. Consumer spending is 2/3 of American GDP. The top 10% account for half of that consumer spending, which is 2/3. And the wealthy are spending due to the wealth effect, right? Their stocks are up and they feel wealthy, so they go spend. Well, if the equity market starts to stumble, as we've been seeing, I would argue going back to October, which is when the rotation really started into consumer staples, into things like industrials, materials, and utilities and healthcare, that all started early November. I would argue that was really the equity market has been sending a signal that is worried about growth, worried about getting defensive for months now. And going back to the consumer spending, so the average American is already incredibly stretched. Top 10%, they're spending because they feel wealthy from stocks going up, but everyone else is really, really stretched. If you look at the personal savings rate, it is near a record low. If you look at personal interest payments, as a share of wages, right? So relative to wages, we have only been at this level where it takes, on average, 108 hours of work per year for the average American to make their interest payments. We've only been above 105 two other times. Here we can see that was resulted in .com. Here it resulted in 2008. So, there's obviously a number of other metrics we could look at, but these are just two that show that there's no real capacity for the average American to absorb $100 crude or $150 crude. Certainly. So I think that, yes, like if you look at the bond market here and in the rest of the world, yields are moving higher. Bonds are selling off. The curve is flattening into this kind of bear flattener. Generally not a good sign. Generally, that is indication of expected monetary hikes in the interest rate and hawkish monetary policy, which we can't have given the state of the debt and what that would do to the deficit. We have rapidly interest rate cuts being priced out of the market. I would say that, we are nowhere near as bad. I'll take inflation off here. We are nowhere near as bad as, say, Great Britain, where their 10-year is up 50 basis points, and they are now, the 2-year in Great Britain is now indicating a central bank hike in England. Now, we're not we're obviously seeing rates move higher, but we are not seeing it to that degree. The 2-year is still below Fed funds. But, in other parts of the world, that inflationary impact from $100 crude, 120, 140, that is kind of the initial thing that's getting priced into bond markets. However, I would argue the second order effect is really what we should be concerned about, which is the demand destruction that happens on the other side. Going back to this, we can see that every time oil makes a big move like this chart has not updated. We are up here. Every time oil makes a big move like that, you get a recession, even if they don't call it an official recession. And we know the average American is already kind of quite tapped out. They don't have the capacity. Oh, and by the way, this is all happening at the same time that private credit is blowing up, I would argue. Like, I'm not normally one to everything's blowing up, but private credit's kind of starting to blow up, we had Morgan Stanley add to Cliffwater and Blue Owl and BlackRock in terms of halting redemptions or gating redemptions in some of these private credit funds, which, by the way, about 40% of the private credit funds are invested in software companies, which are the very companies to be disrupted by AI. So, AI might have been the first spark, right? We know IGV, for example, just absolutely cratered. We've gone over that on other shows, but, that is where the majority, a huge share of this private credit was invested in software companies, which are the very ones being disintermediated by AI. Private credit starts to have a wobble. Well, that's probably $5 trillion right there. Here, by the way, it's not just private credit. The major banks have huge exposure to private credit. We're looking at Bank of America here, almost in a bear market. Bank of America. The major banks, BlackRock here we can see, and we'll go to another one, JP Morgan. All the banks, all the financials are indicating stress. Here we're looking at regional banks. Here's Morgan Stanley, obviously gapping down after the news they're gating redemptions. So yeah, the banks are not doing well. Here's Wells Fargo. They have huge exposure to private credit, like 10, 20, 30, 40 billion dollars worth of exposure to private credit. Most of that private credit, most of those loans are in software companies, which are being disrupted by AI. And we know that because we can look at the equity market and see the rotation under the surface back in the start of November, where consumer staples, industrials, materials, utilities, and healthcare all started to outperform the broader market? Well, if you think about it, two of those are kind of conflicting, right? Industrials, materials, and staples and utilities. Those indicate generally two different things, right? Recession, high growth. But the common thread this time is none of those can be disintermediated by AI. So I think that, again, the equity market has kind of been indicating significant concern. If you look at credit spreads, they are not blowing out, right? They are elevated from where they were in early to mid-January. They're elevated, but they are nowhere near blowing out, right? Here is, the kind of zoomed out picture on high yield option adjusted credit spreads. So we are not at like a panic level yet. 2008, they blew out to 21%. Right now we're at 3. The only thing I would point out with credit spreads, we have only been this tight at 2.7 one other time, and it was right before '08. So I think personally that we're late in the credit cycle. I think personally that we are on the verge of a recession if oil continues to do what it's doing, certainly in Europe and certainly in Asia. But we know how interconnected the world is, right? We know how, for example, the Gulf countries not being able to export and run a trade surplus, run a current account surplus. Those Gulf countries were the ones pledging all the investment into AI data centers here in America, right? So you remove their current account surplus. Well, the other way of saying that is you're reducing the amount of foreign outbound capital that is flowing in. And we know a lot of it was pledged into America into this AI trade. So it's all kind of connected, not to be that guy, but it is kind of all connected. We have 5-year break evens that are moving higher. However, the real rate on U.S. Treasuries actually quite contained, quite low. So here's the 5-year yield minus the break even, and we're only at 122 basis points. But if you look at 5-year break evens, they have moved a little bit. So I would keep an eye on this. The bond market is definitely worried about inflation, but again, I would argue that it's a bit short-sighted. Once you include private credit, once you include the job cuts coming out of Oracle, coming out of Square, once you dig deeper into the ADP data or the JOLTS data or the NFP data, we know that the sectors that can be disrupted by AI are the ones that are facing weakness. Information, professional, and business services combined, according to ADP, have lost 500,000 jobs. Now, some of that is labor market normalization, right? We got a little crazy 2021, but I think that we are seeing AI-related job loss. If you look at Challenger Grain Christmas, which publishes a private report on layoffs specifically, they are showing that AI is the second most cited cause for firms to lay off employees. So, I think the AI job displacement is here. It's in white collar work, right? And white collar, middle to upper middle pay a huge share to the government in terms of income tax. And as Luke Groman says, does AI have to take every single job? No, it only has to take 10%, 15%, and then systemic leverage will do the rest. We know that the U.S. can't really afford a recession, right? Going back to oil and the demand destruction on the other end, which I finally hear, the professionals talking about, going back to that, if we go into a recession, again, number one, Bitcoin, I think would do very poorly. I think we could see, 4-digit Bitcoin, maybe. I'm not short or anything, but I think it could do quite poorly in this kind of deflationary sort of environment because it's high beta. As much as we might look at it as money, it's not how the majority of market participants look at it. They look at it as high beta. It's going to get crushed. But then what's going to happen? In a normal recession, expenditures go up by about 15%. Revenues for the government fall by about 20%. So you just widen the deficit from an already insane 1.7, 1.8 trillion to about $5 trillion of new debt would have to be issued just if we go into kind of a normal recession. $5 trillion of new debt would have to be issued each and every year by the U.S. government just to keep the lights on. And I think that, the Fed would obviously have to buy a large percentage of that with freshly printed cash, bank reserves. And I think, in that environment, private credit is blowing up. Well, that's $5 trillion. Oh, the mortgage market's gone. That's, 11, 12 trillion. The amount of stimulus that will have to come in this environment is going to be immense. So kind of, just zooming way out to summarize, like the way I kind of see this going is, Bitcoin could fall quite significantly. And then once that margin call hits, once the recession and the math actually starts to hit, they print an ungodly amount of money and Bitcoin goes to 500,000 million. I mean, the sky is kind of the limit in this environment.
I think that everything you said is extremely bullish for Bitcoin.
Yeah. I've always said. That's what I've always said. Yeah. Yeah. Recession is the most bullish thing for Bitcoin, as long as you have a long enough time horizon.
But the way that I look at it, even in the short term, I think 4 digits is extremely low. I don't think it'll ever go that low. Because I was looking at money market funds, like the amount of money that are in there right before recessions, it seems like they actually ramp up.
Yep.
And then they fall slightly. But with, let's say, for example, these money market funds, they all pay you 3-4%. Again, STRC, they have 2 years of cash set aside and they can raise more cash whenever they want to. So what that's going to do is it's going to bring more money into STRC, and MicroStrategy will be able to buy more Bitcoin and they'll create that floor. I don't think it'll ever go that low. So let's say, for example, if it goes to like 10K, Strategy, so last week Strategy bought 18,000 Bitcoin, but if it goes to 10K, that same buy would have been, let's say they have $2 billion set aside in cash right now. Let's say that $2 billion worth of Bitcoin, how much is that if Bitcoin goes to 18K? I don't know what that number, or sorry, 8K. Let me do that number. So they have 2 billion in cash right now. They're not supposed to use it to buy Bitcoin, but if Bitcoin goes to 10K, they can easily buy 200,000 Bitcoin in one trade. Right. So as the price goes lower, they're able to buy more and more Bitcoin. So actually, I think that all of this is going to push Bitcoin even further because it's the only digital bearer asset. All of the money that leaves, let's say, the stock market, it has to find another house, right? That
bonds.
House is Bitcoin.
Bonds.
Oh, even bonds. I mean, let's say, for example, bonds, they give you a 3% return. STRC is better.
Yeah, I agree. I would just question like how does, because really at the end of the day, what we have to look at is not how we view it, but what the market is indicating, right?
Yeah, and I would suggest that like the market is going to buy bonds in this environment, not necessarily go into STRC. You probably need a track record of 5, 10, 20 years of STRC to even compete with that quote unquote institutional flow from an attractiveness.
Yeah, because they're going to be worried about MSTR. They're going to be worried about, MSTR leverage to a high beta asset. Like whether or not
they don't necessarily own these assets. They don't necessarily own these assets though, right? To bring the price down. So they don't own Bitcoin to sell into the market. So I don't think that they can bring the price down, because if they don't own it, then how are they going to sell it into the market? How would they drive the price down? Maybe they can use futures. I'm not sure of the exact mechanism that they could use, but the way that I understand Bitcoin, eventually the sellers run out of Bitcoin, right? If they don't have Bitcoin, how are they going to bring the price down?
Well, no, I'm saying that like the people that view Bitcoin as money, we're like 1-2% of total capital out in the market. Like Bitcoin being what 1.8 trillion. Like there will be a ton of short interest on everything high beta. I'm sure. Look, if you look at ARK or something, anything high beta, look at Palantir. I bet that the short interest in these will just absolutely ramp up. Again, if I'm correct, and there is a kind of recession on the other end of this, anything high beta is just going to get crushed. We're like the David versus Goliath, like we're trying to hold back, we're a tiny fraction of the capital. Most capital is going to flow into bonds because that's just how it's always worked. Should it flow into STRC? Yeah, I mean, if there's a guaranteed 10-11%, you would think it's a no-brainer. But then my question would be, okay, so why isn't it? Why is only 400 million out of FX trades 7 trillion per day, for example, like, why is
I think it's just so new, right?
Yeah.
I think it's picking up.
Right? It could be just a timing issue, and maybe it's not a this cycle recessionary thing, but it could be next cycle's recessionary trade where they do pile into STRC as a significant alternative, rather than just, you know, 0.5%, 1%, whatever percent of that institutional bid is now moving there. So it could just be a timing, right? Like it really could just be established that market presence and reputation, and, you know, take it from there. But on that note, so I do want to be respectful of Info's time. I know you have to hop. Guys, this has been a fantastic conversation. Rajat, so great having you on. Really appreciate
you having me.
You coming on. We should do this again soon. It was a ton of fun. I feel like we didn't even get into half of the macro stuff that we should have got into, because there's so much going on. Infra gave us a fantastic summary on, I guess, why to be short-term bearish and long-term bullish. Timing, as ever, is the biggest issue, and trying to figure out when that occurs is obviously tough. But guys, I do want to call it there. Thank you so much for hopping on. Fantastic conversation. Everyone in the comments, we appreciate you. Sorry we couldn't get to all of the questions that you had. We'll do our best next time. And yeah, thanks everyone for hopping on. We will see you next week at 12:30 Eastern. Have a fantastic rest of your days.
Thank you for having us.